I want to introduce the concept of portfolio insurance. Now, portfolio insurance is a way to protect a portfolio of assets. And it was actually the brainchild of Hayne Leland and Mark Rubenstein, two professors at Cal Berkeley. Now, the idea is to create a payoff that mimics a call option. If you think about a call option allows you to take the upside if the price goes up, but simply to lose the premium if the stock price goes down. So this is a great way to make money, okay, but to limit the downside. Now, what Leland and Rubenstein did is they looked at the relationship between stock prices and call options on the exchanges. And here are some of the facts they noticed. Call prices and stock prices change in the same direction. So if the stock price goes up, then the call price goes up. A $1 change in the stock price causes a change of less than $1 in the call price. When the call is deep out of the money, that is, it's very low relative to the exercise or strike price, a $1 change in the stock price will have little effect on the call price. And that makes sense because if it's way out of the money, even if it goes up a little bit, it's still not likely to be exercised. If the call is at the money, that is, the stock price is the same as the exercise price, a $1 change in the price of the stock will produce about a 50-cent change in the price of the call. And if the call is deep in the money, that is, the stock price is well above the exercise price, a $1 change in the price of the stock produces almost a $1 change in the price of the call. So when the stock price is low, this concept of portfolio insurance is essentially to hold stock and cash. So when the stock price is low, you hold almost no shares of stock. You hold a lot of cash. Around the strike price, and that's the case where the call is at the money, you hold about a half a share of stock. And when the stock price is very high, that is, the call is deep in the money, you keep buying shares until you hold almost one share of stock. Now, they've scaled this. Nobody buys one share of stock or half a share of stock. So what they're essentially doing is creating a synthetic call option. And I have a video on creating a synthetic call, and you can do that if you combine a long stock position with a long put position, because the put makes money when the price goes down, and if the price goes up, you just throw the put away. So essentially this is a way to insure a portfolio. And what Leland and Rubenstein did is show that by changing the stock and cash position, you can essentially create this same payoff. It turns out that the slope of the call price curve at the current stock price is the number of shares in the replicating stock cash portfolio. And we need to do a little bit of an adjustment. We can't just adjust for price, we need to equalize rates of return. And the reason for this is that a call uses leverage. Remember that to control 100 shares of stock, you don't pay $100 per share, or you don't pay how much it would cost to buy that stock. You pay simply the premium. So for $300, you might control $10,000 worth of stock. So there's a leverage effect. And this can be done by using borrowing to finance the stock and cash portfolio. So let's take a look at a graph here. This is a graph that appears in the Financial Analyst Journal from a paper that the two of them have written. And what the graph has here on the x-axis is the stock price. And on the y-axis, it's the value of the position. So you'll notice that if you're long one share of stock, no borrowing or lending, it starts at 0 here, and as the price of the stock goes up, the value of the position increases. And you can see this has a slope of 1. So for every dollar the stock price goes up, the value of the position increases by a dollar. But that's not really how a call option looks. A call option looks like a hockey stick that goes this way and then has a slope of 1. So how did they get this curve to shift to here? They get this curve to shift by simply borrowing money. And what they do is they're long one share of stock, but they borrow the striking price forward. So they borrow, in this case they're assuming the striking price or strike price, exercise price, whatever you want to call it, is $30. So they've borrowed that $30. So you'll notice this shifts parallel, and this investor could have a value of a position of minus 30, and it has a slope of 1. Now, down here, when the stock price is really low, much lower than 30, you don't own much stock because simply, and again, it's always one share of stock. We can always scale that up. Why is that? Because if you're down here and the price is, let's say, $2, if the stock price went up by $1 or $2, it would still be far below the strike price, in which case it's really out of the money. Nothing's really going to happen to the value of that call option. Now, as we get closer to the strike price, it starts to curve up. And here, at the strike price, they've drawn this line here that's just tangent to this curve. Remember that a call option, while we're used to seeing that hockey stick look, that's for what the payoff picture looks like at expiration. Before expiration, the call has some time value, so there's some curve here that curves and then approaches this slope of 1 here. So in this case, they've said that here this has a slope of 1/2, so you should buy half a share of stock. You'll notice that down here, if we draw the line tangent, and they call this the slope of this line is the number of shares in the replicating portfolio. You notice down here, if I rotated this, the slope would be close to 0. So you would hold almost no shares of stock. But as the price gets well above the exercise price, the strike price, so let's say it's $40 a share, this would rotate this way. It would rotate counterclockwise, and you would have a slope that was close to 1. So this is the finding that Leland and Rubenstein made, is that you could actually create this call option by owning stock and a cash position and adjusting it based on what the stock price was relative to the strike price or exercise price. And they actually tried to do this, I believe, using Vanguard's Index 500 mutual fund, as well as Vanguard's money market fund, or one of their money market funds, because the expenses are very low, and that these are no-load funds, so there's no cost for transacting. And they would keep adjusting the portfolio based on what was happening. So if the market is tanking, the market is going down, what are you doing? You're selling stock and holding a bigger cash position. That gives you a floor. That limits how much you can lose. Of course, if the market is going up, then what do? You take your cash position and you convert it to stock so that you can participate in the gain, and that would be up here. So this was a really ingenious discovery. The notion of portfolio insurance popped up a lot in 1987 when the stock market crashed, and there was a lot of talk about whether it worked or not. But the concept is quite clever. That by simply adjusting the cash and stock position, you can actually create a call-like payoff strategy.